Thank you everyone for coming in today. Today's session, second session of this season, is with Alex Baker. Alex is his partner at Relay Ventures, and he's been very kind to share some of the insights that he has gathered over a period of time as an investor, as well as someone who has seen startups grow very closely. But today, while we would focus on a lot of things about startup fundraising in general, but we are going to be talking a lot about how has COVID changed startup fundraising, the timeline, the impact on businesses, and what is the outlook that he has for startups in general and Canadian startups in particular. But before we do that, I would want to take a couple of minutes to talk about TIE. In case you're not aware, TIE is world's largest not-for-profit organization with a single-minded focus on fostering entrepreneurship. We work very closely with startup founders. It's run by volunteers. My name is Kanchan Kumar. I'm founder of Remitter. Remitter is a business payments company headquartered here in Toronto. And while I run my startup, I also volunteer my time because I'm passionate about entrepreneurship. And people like me, people like Alex, they give their time to run this organization. There are 4 pillars on which TIE is built on: education, networking, mentoring, and investing. So there are 2 parts to TIE. One is a set of charter members. Charter members are by invitation. They are experienced entrepreneurs, investors, professionals, executives. They support the chapter. And then you have associate members. Anyone could become associate member as long as they have passion for entrepreneurship. Either they are entrepreneur themselves, they're working with startups, or they have a keen interest in this. And it's the charter members who support entrepreneurs, and that's the reason why they're called charter members, because they don't not only support financially, but they also support members with their time. And these time that they give is done in multiple different ways by running educational programs where they contribute. They help take the startup founders to their network in terms of help them either fundraise or go-to-market activity, or just simply spend time with them in helping their business grow. And all of this is pro bono. There's no fee. Just pay 1 membership fee and you get everything included in that. In this season, we started out by doing a program. Some of you attended that program with Mike Ho. Mike did a wonderful session talking about priority mapping and how do you align your product with market opportunity. This was very well received program. We have a video of that available. If you look at our YouTube channel, you would get that. Today, we are talking about fundraising for startups that I'm going to be asking a few questions to Alex. But during this coming weeks, we are going to talk about a whole lot of things, and we have some impeccable speakers who are going to be sharing their experience. That's all from my side. I would get Alex on board here. Alex.
Hi.
Thank you so much for taking this time out. And
my pleasure.
So we're going to have a lot of insightful conversation. To get started, Alex, tell me something about Relay Ventures, what kind of companies you look at, and your background.
Sure. So we're based in Toronto. We've got an office in San Francisco. We are managing $600 million of assets. We're investing out of our 4th fund. The current fund's $150 million, and we're typically entering at seed. And then participating throughout the life cycle of the company. To the extent we can keep our pro rata at the later stages, we try to. And so we end up, in a portfolio of $150 million fund, we'll end up with, 35-ish seed investments that will eventually, a fraction of those will end up converting their way to kind of a Series C, Series D, Series E's through the life cycle. And it's been this fund is a vintage 2016 fund, late 2016 fund. So we're currently looking probably at the last 4 investments out of this fund. And the fund itself is tech focused, which may be important for some of the viewers out there. We are focused really in 4 key sectors. One is financial services, which is obviously how you and I first met. Mobility, and think of that as like micro mobility, prop tech, and then sports tech. So those are the areas. We will invest anywhere. We can invest anywhere in the world, but realistically speaking, we'll invest anywhere in North America. But 60% of our portfolios in Canada, 40% in the US. But capital allocation is exactly the opposite. So as you can imagine, deals in the US are still requiring more capital to get our ownership and our target ownership to a point that makes sense for the fund.
Awesome. So you said that you typically invest early stage. So how early is not too early?
Okay, it depends on the timing of the fund, actually. So you got to think about it in terms of like, I'm assuming that these are mostly entrepreneurs that are out in the crowd, and many of which are, at the stages maybe, Kanchan, where you and I first met, or even earlier than that. And so you guys, you got to be cognizant of 2 things when you pitch funds. One is that the fund strategy, or the target deals, the strategy probably doesn't change over the course of the fund, where we have a group of LPs that invest in us for the strategy that we propose. But the stage at which we will invest now is somewhat, quote, later than we would have 2 years ago. In other words, 2 years ago, we would have done a deal that would have been a team of 5 or 7, pre-commercialization, early technology already written and deployed, but mostly in a testing phase with a little bit of proven scalability because the team's got some experience there. Now, the biggest, I think the first hurdle, the first gate to get through to move to a next meeting or to be interested is a company generating, call it 100K of revenue a month. Depends on if it's transaction revenue or SaaS revenue, monthly recurring revenue. So that is important to us. We could be the first money in, but we could also be kind of seedish, early, what I'll call early Series A, just because the size of Series A deals have changed dramatically in the last 18 months.
And this is purely linked to the stage of the fund that you are in, which basically means that when you raise the next fund, you would again go back to starting a little earlier, right?
Yeah, reset ourselves and start a little bit earlier. That's right.
Yeah. So that's.
But it's also going to be like, just to be clear though, because maybe it wasn't from the last point I made. I mean, the here and now, you get a sense of the $100,000 or more of monthly revenue, or approaching. But the earlier that you are in the investment horizon of the fund, the longer you actually have to maturity. And so if our funds are 10, 12-year horizon funds, you can imagine that we want sort of the first 2 years of a business behind us, so that we're talking about an 8-year horizon or 9-year
horizon. And are you looking at anytime soon new fund being raised?
Yeah, I think we'll probably target sometime next year for the next fund. As you guys know, the environment is, it's not that it's changing, right? Typical LPs, if we were to go talk to them in March, April, and May, especially a lot of the corporates, they were like everybody, I'm sure, on this call, they were in crisis management, and investing in a fund wasn't top of their list, but things are on pace now. So we, the cycles are kind of every 5 years, 4 to 5 years, you raise a new fund. And so we'll be somewhere in the market kind of mid-year next year.
So it's interesting that as founders, we think of fundraise from VCs, and we possibly have seen the same kind of scenario play out in front of us during COVID. And you as a VC see something similar happening with you when you approach LPs as well, right?
Yeah, we're not immune. Nobody's immune to it. The priorities of the funders change. So if I look back 6 or 7 months, we were looking at our portfolio, having daily phone calls, understanding what the burn rate of the portfolio was, what their plan was to extend runway. I'm sure, like, if I think about the people on this call, you probably all had very similar calls with your investors, your boards of directors, your peer groups, your founding groups, etc. And that, again, that mindset's changed now, where we've gone from a defensive strategy to way more of an offensive strategy.
So before we get into the fundraise part of it, if you could share from your portfolio's experience, without possibly getting into the details, but how do you think has your portfolio done during this COVID, and what was the strategy which really worked very well for them, both in terms of surviving and thriving?
Yeah, I don't want to say this answer is easy, but it certainly is something that I've had a lot of people have asked me the question. So this is sort of how I look at it. I would say if you think about a traditional early stage portfolio, let's say a year ago at this time, we would say 40% of the companies were killing it, right? Like, they were exceeding our expectations, exceeding plan, out raising capital with little, with very little limitations, and likely, overachieving. And then I would say the next 40 were just sort of, and that would mean 100 to 200% or sometimes more annualized growth. Next group of companies were kind of somewhere between, I don't know, call it 30 to 60 to 30 to 90% or 30 to 100% annualized growth. Doing well, cash management is not an issue, plenty of capital on the run to achieve the milestones to the next funding, but not aggressively growing. And then you have the remaining 20%, which are kind of flat growers, maybe having problems, etc. I hope that adds up to, I certainly hope that adds up to somewhere close to 100, but you sort of get the distribution. I think now you're talking about 25% of the portfolio that's just knocking it out of the park, that's counter-cyclical, that's overachieving any goals that you would have set even in a non-COVID year. We've got a few of those that are just like unbelievable to watch, that are just being run like a well-oiled machine. Like, I'm trying to think of a good sports analogy, like the New England Patriots of the prior to this, of the last 13, just like everything's clicking. The offense works, the defense works, the team's working in concert. You're putting a substitute in, they're working because they understand the system. It's just, they're beautifully systematized. So that's about 25% of them. I'd say about 50% of them, or 40% of them, are kind of, again, in this, it's not 100. It's like, now it's about 25 to 75% growth, and then you've got a bigger number margin, 25 to 30% of them, maybe 40% of them, where it's not going to be a great year, and we got to hope that they're going to come out of it next year. So, does that make sense? So,
Yeah.
the great ones are still overperforming. The poor ones, the buckets increased a little bit, and the mid-tier ones, they're going to perform and they're going to get out of this. They just need to sustain themselves.
Great. So coming to the fundraising, what do you think is the fundamental shift which has happened in startup fundraising, if at all there's a fundamental shift in startup fundraising? Have you seen the startup profile change, or have you seen among the investor their outlook change?
Okay, outlook has changed for sure. I mean, I think investors are more bullish than they were a year ago, almost to a point where at the beginning I thought it was a little bit obnoxious, but it actually seems to resonate and seems to hold true. I think part of the reason for that is that there's just a lot of capital at the top of the market. And so if you look at fundraising trends for the last year, you can see the majority of capital has been invested into these mega funds of, call them $500 million and above. You could even increase that to 750 or $1 billion funds. There are plenty of them, and they need to deploy their capital. And the one way that they're looking to deploy their capital is they quote sure things at the later stages, the D's, the E's, etc. But they're also moving way downstream. And so what's changed is that there is either a lot more capital available at the earlier stages, um, and B, that valuations have increased substantially for those companies, because if you, as VCs, we try to achieve certain ownership thresholds, and as entrepreneurs, you guys try to achieve or optimize for, and rightfully so, for dilution, or not as much dilution. But you don't optimize for. If you optimize for dilution, that would be incorrect. You optimize for ownership. Okay, so if you look at those two, factors, they're driving up valuation. They're driving up capital that's going in, which then in turn means that those businesses really have to be achieving either growth and momentum, or at a revenue level that justifies a certain amount of money. So that is to say, companies are maturing faster. They're maturing faster because there's more capital being injected into them, and there's being more capital injected into them because there's more money in the larger funds that's moving its way downstream.
Great. So that's interesting, because beginning of the pandemic, everyone had a very negative view on what the fundraise environment will be for startups, right? And it has shifted to a place where now there's a lot of money available. You just have to fit the profile, and then that money is for you to take. So that I think is a very interesting take. But what does that mean in terms of fundraising environment for early stage startups? So late stage, I can completely understand, because you have the revenue numbers, you have the traction numbers to actually go show and prove that, yes, more money means I can scale faster. But what does that mean for early stage startups?
Well, I think there's still capital.
Seed to Series A.
Yeah, there's still capital in the seed and Series A guys. We're still writing checks. There's a bunch of funds in Canada that, as an example, that are still writing checks into seed and Series A. And frankly, there's a lot of US funds that are doing Zoom sessions with entrepreneurs and financing based on an hour to 2 hour call with them, and based on some of the other people that are around the table and existing relationships that they have. I think the money exists there. What we're seeing is it's coming in less and less. It's coming in less and less as priced rounds, and more as convertible notes. And that's been a trend that's been happening over the last 4 or 5 years. So they're coming in convertible note with a cap, which is really an implied valuation, and getting to a point where the quote later stage guys that are moving earlier will actually fund the thing. And so we're seeing, even in the deals we're doing, it is unlikely that we would do a deal in a seed round of less than $2 million. Those seed rounds are probably more like 3 to 5, and A rounds are north of 10.
Awesome. How has this changed in terms of the process? Like you said, I mean, I have certain experiences, but before I do that, have you made investments where you have not really met the startup? The first meeting was a Zoom meeting.
No, we haven't done that yet. So we have made investments in companies remotely. We had met the company before. We've known a co-investor or a member of the team for a long time, or invested in them before. And that's sort of the way the criteria has changed. It would take an awful lot for us. Look, we are heavy-ish on governance. We take board seats in the deals that we do. We participate at pro rata our intention is to get in there and be around for the long term. So we develop a relationship. We open the Rolodex up. We help with commercialization. We help introduce support for sales, marketing, technology, where we think you need help to get to that next level. We do a lot of work with the company in recruiting executives. And so, I would say that we haven't pulled the trigger on these quote remote deals, but the market in Toronto is very hot right now. There's a ton of great deals to look at. And I don't think that there's a reason for us to pull a trigger over a Zoom-based deal where we can still do, a backyard visit or a walk with an entrepreneur or a coffee outdoor somewhere to get to know them a little bit better. And by the way, there's a lot of capital in Toronto to be able to do that as well.
Yeah. Have you heard of deals in your portfolio companies being done, which was entirely done on Zoom, where the first meeting happened on Zoom?
Yeah. We've had a couple of portfolio companies that have gotten completely financed out of Zoom. And by the way, on later stage deals. So it's happened. And much to my shock, I like to tell like a couple of our entrepreneurs that are very optimistic. I'm like, I think you're like a 9 out of 10 on everything you say. I'm like a 4 out of 10 on everything you say. So we end up somewhere around, a 6.5 or a 7 as the reality. And so they'll be like, well, I've got this meeting with this financier in San Francisco or New York, and they're interested in financing the next round of the company. I'm thinking to myself, this is great, but I think there's zero chance. Sure enough, 2 weeks later, there's a term sheet sitting there in their inbox.
Very interesting. I mean, I remember even a year ago, if anyone would have said that an investor is going to put money in real money, not 100K and 50K checks, without really meeting the founder and the founding team, no way, right?
So I have heard, and I think I mentioned this to you, I've heard of several companies in Toronto that are doing $3 million, $2, $3, $4 million, somewhere around that a year in revenue, getting phone calls inbounds from venture funds that are basically saying, we want to do this deal. Here's a term sheet. It's a large fund, so there's going to be like some secondary involved. The terms are good. They're not fantastic, but they're good enough. And a companies that haven't really even thought about fundraising, all of a sudden are thinking about it because there's an opportunity sitting in front of them. And it's kind of interesting because you want to make sure that the funder is going to be around for a long time, and they're going to be involved, and they're going to be helpful to the business, because otherwise it's useless to take their money, in my opinion. Money is money, and great businesses can find money in places. It's just what comes with the money that's the most important thing. And that's the good and hopefully not the bad that comes with the money.
Yeah. In your experience, both with your own investments as well as your portfolio companies, have you seen the evaluation criteria or the methods change during COVID?
Evaluation criteria for sure has changed. And so what we found is there's a lot, look, before COVID, at the later stage, there was a lot of focus on things like Rule of 40 and just becoming more financially prudent in the companies. Rule of 40 was one that played out a lot. I mean, we hear the traditional things around, CAC recovery, recovering the cost of acquisition. We hear, there's obviously a lot around lifetime value. I don't necessarily personally buy into that metric so much, but we hear a lot about retention, et cetera. That's changed now. There's been a huge focus change. And I was just talking to my partners about this. I've seen it in our companies around, net and gross dollar retention and the importance of that. Because I think in a time compressed period where companies have had retention issues, the ability to show that you're still able to upsell to your current base is actually quite amazing, and it's quite a great message for the external market. We've got those. That's where you really feel, and it really shows where the product's extraordinarily strong. Kanchan, I noticed that there's a couple of questions here. Should we try to address them, or you want to keep going with the list that you've got?
Yeah. So we could certainly take up a couple of questions. We had sent an email and asked you questions in advance. So I'll take them first and then take these questions, if you're okay with it.
I'll leave it up to you. Yeah.
So COVID has led, so one of the questions which came in was COVID has led to increased digital transformation and virtualization. What do you see the impact of this on various different domains, and where are the new stars going to come from, which basically take advantage of these?
Well, so I think that, look, the big thing that we've heard is around the future of work, and the future of work is, the largest sort of trend that's playing out right now. The whole idea of remote workforce, the whole idea of real estate of the future, the whole idea of connected threads and connectivity. It's obviously an area that we're looking at in the context of our real estate portfolio and technology enabling the future workforce. We're also seeing it on the sports side, and the fact that sports arenas are empty. So I would say those are some key areas that we continue to look at. But the biggest one, I think the biggest wave of the next, if you look at the context of the fund, the next big wave is still going to come on the future of mobility and what that looks like. And the reason I say it's still to come, obviously we've all heard about autonomous vehicles. I think that's something different. And I look at the market right now. If you think that the market right now for mobility, micro mobility, is much hotter than it was at the beginning of the pandemic. Nobody wants to really take the subway, as an example. There's a strong preference for scooters or bikes over the subway. There's a strong preference even for Uber over the subway. There's a strong preference for fractional car ownership over public transportation. There is, a strong force pushing people who were over 16 and never got their licenses before to now go get their license because they don't want to be inside a vehicle with someone that they don't know. So I think it perpetuated a part of the market that we're just not even really talking about that much. And when we talk about it, we talk about the fact that Uber's getting killed on the public markets, except for, the new legislation that passed that caused a bump. But Lyft, Uber, like, look at their market caps compared to what they were when they went public. So I think there's a big piece around, the future of mobility. I think, you're in the financial management space and money transfer space. There's still an awful lot that's going on there, especially as teams are distributed now, and there needs to be processes and checkpoints that are put in place to make sure that there's proper review of monies that are paid and monies that are received. So I think that that plays well into, again, a trend that you're likely seeing, and I'm sure you're seeing some incredible increases since last year in your payments transaction flow.
That's right. So we have seen. Our transaction volumes have simply doubled quarter on quarter. So certainly we have seen an amazing acceleration. Now, talking of future of work, one of the things which I wanted as a follow-up question was, what's your view for an early stage startup to be fully remote or distributed teams? It wasn't something which was looked very kindly upon earlier by investors, right? But now the situations have changed. What do you think is going to happen?
Well, I think that for the time being, in the next year, as investors and board members, we can't expect that workplace is going to return to normal, no matter what the city is, full stop. And so we have to accept that distributed workplaces are going to have to work, and there's going to have to be demonstration that they are working. And I will tell you, interestingly, we have had a couple of our companies that where their leases have come up, and they've basically walked away from them and said, for the time being, we'll go virtual, and we'll find meeting space if we need to find meeting space. So I think that not 9 months, 10, 12 months, it could even be more. We're going to have to accept this. But I think once things come back to normal, I'm a traditionalist kind of person. I think that virtual works, but I also think that there's something to be said. Forget about the whole water cooler mantra, but there's just something to be said from the energy that you get from being around other people. It depends on the function also, right? It depends very strongly on the function. Marketers, salespeople, they learn from hearing what's going on around them, especially junior folks. Same is probably true for engineering, but a lot of times they're kind of heads down, headphones on, and if they have a question, they can ask it. I still think that a subset of those people will work better with the competitive juices flowing and having the person next to them typing faster or hearing clicks that are quicker, or the notoriety that goes along with achieving something and getting and having an immediate reaction, and stopping everybody on the floor and saying, hey, this person just did a great job. Check out their piece of code. So I think we're going to return back to something. But in the next 9 to 12 months, I think it wouldn't even concern me for a second if I looked at a team and they said they're fully distributed.
Great. I'm sure this is helpful to answer, because this is one of the concerns which I have seen in the startup founder mindset, that investors prefer team which is working together. We prefer team working together, but situation has changed and we can't really work together. And that has both trade-offs as well as opportunities. Yeah, great. So one of the questions again, which came in earlier, was how do you see the 5G technologies impacting the new innovations?
No, we see. Sorry, which
5G,
technology?
5G.
5G.
Yeah.
I was just having a talk with a friend of mine yesterday or 2 days ago from Rogers about this, and I mean, this is all really about the speed at which you can send information, to and from devices, and the amount of computing that's going to happen at the edge. And so, the stuff we're looking early at some of these technologies now, particularly as it relates to autonomous vehicles and robotics. And basically having GPUs at the edge, and being able to do extraordinarily difficult things that we couldn't do in another environment. So it will have some impact, but it's also going to have it's going to take a ton of time for it to be rolled out into smaller, more rural settings. And so until there's wider distribution of 5G, I don't think that there's going to be. I think that we're talking about technological impact that's probably 2 to 3 years out, in terms of huge commercial successes in a venture back company.
Great. So I would take audience questions now.
Well, we can go through. I see the first one is, do you invest in marketplaces, new retail technologies, AR and VR? We have an awesome project with a spot on idea, and I'm looking for the right place to partner with. Already got some investment from angels. We're in development, MVP stage. So for us, Sebastian, thank you for the question. I'd say ordinarily, yes. Marketplaces, new retail technologies, probably more in our sweet spot than AR and VR. Although we've looked again at all of those. But for us, really, right now, today, it depends on the revenue traction of the business. Full stop. So if you had 100K of monthly recurring revenue, would be something that we would be interested in looking at. If not, let's wait a year, take a look, and at that point, might be more appropriate. Since the pandemic, it's become more difficult for product hardware startups early stage to raise funds. Is that a fair assessment? Would love to hear your thoughts as an investor, how you see investments growing, declining for early stage hardware startups in the current scenario. Vishal, that is 100% true. So I did talk about the later stages. I did talk about investment happening at a pretty torrid pace at the later stages. I mean, the reality is it has pulled back by probably 60% at the seed. And at that point, I have to say, it's becoming the deals that were typically getting funded they're just extended. The angels are just extending them, or the angels are just not continuing to fund them. So yes, it's become extraordinarily difficult to go out and raise a fresh seed, new first round of financing. It doesn't matter the city that you're in. It is true in California. It is true in New York State. It's true across the country in Canada, that money is really being focused on less risk, but also less reward at the same time. Would love your opinion on investing in blockchain, DAO, security, utility tokens, with new term sheet via smart contracts. How are exits on decentralized exchanges viewed as IPO versus IPO as former pacing up to ladder's scale? That's a Deepak, you're asking a tough question, buddy. So we purposely scaled back from any blockchain deals that we started looking at 4 or 5 years ago. The reason we pulled back from a focus on that wasn't because of a disbelief in the theory behind it. and the technology behind it. Conversely, I think, I own some Ethereum. I think that, the idea of smart contracts on a distributed basis is absolutely got merit. But 5 years ago, I didn't think that we would see maturity and exit potential out of those businesses for 15 years. I think we're in a different space now. I think the big trend we're seeing right now is this, the DeFi tools. And look, to the extent that those are actually real applications that are written on top of blockchain that have a purpose inside of the financial services world. In terms of term sheets via smart contracts, not really my area of specialty. And I think there will be some consolidation on, a number of these decentralized exchanges. But viewing them versus an IPO, I can't really comment on that. I think there's enough insecurities right now on in the public markets. Both, IPOs are strong, obviously, but what's going to happen with SPACs and all of the targets and all the SPACs that actually need to deploy their capital. What's that market going to look like over the next 4 to 6 months, and how are those stocks going to perform? I think this is more where we're looking, what we're looking at as versus the alternative to it, as an alternative to an IPO. Centralized and dedicated space for anime, art, and video games. I mean, look, that sounds interesting. We're doing work, as I mentioned to you, in the sports and entertainment space. And provided there's some real commercial traction there, or early commercial traction, it's something we could be interested in.
One of the questions just come in the chat, Alex, is since you are in prop tech, with the growing work from home trend, do you see home tech becoming important?
Oh, I mean, that's interesting. It's an interesting way to look at it. I would say we're seeing a lot more activity, I can tell you, out of our companies that focus on the home and the consumer market. We're seeing a ton of activity, and positive activity. I mean, very good retail sales. Greenlight is a debit card for families, is a good example. And you would say to yourself, well, if kids aren't allowed out or going anywhere, where exactly are they spending money on their debit cards? And the answer is where the rest of us are. Amazon, Walmart.com, video games, etc. If you look at companies like Circle, meet Circle.com, which is a device management platform. Again, great retail uptake, great retail sales, as many people are at home and they're witnessing their kids being on their devices and the internet too much, and they want a way to help manage that. So I think those two trends, digital is one. The second place that we're seeing it is hard goods. So if you think about home tech, but don't think about it as pure technology, let's think about it as, the next generation shower head. Think about it as furnishings. If you look at Wayfair's results, if you look at Overstock's results, it's no surprise. I mean, this is the transition has happened. People are, home goods purchased through that is going to be just going to continue to accelerate. And I think that and there's new technologies, whether they're payments technologies or Bluetooth technologies, or tracking technologies that are being embedded in some of the home good items to create more tech, are things that we're absolutely seeing. And look, even companies that are selling clothing, and that's technology driven clothing, and I'm not talking about a connected bracelet. I'm talking about the way things are manufactured in more of a technical way to either whisk away sweat. Those are hot areas. Also if you look behind me, that just in terms of home gyms and how that's transitioning. You look at the moves that companies like Lululemon and Nike are making to acquire companies to make them more relevant. Under Armour, interestingly enough, is actually divesting out of MyFitnessPal, which was supposed to make them more, quote, technical. But my point is, absolutely, home tech is a major area where we see tremendous growth opportunity.
Related to this, my question is about esports. Sports arena isn't coming back to life anytime soon, and that creates new opportunities. What's your outlook on that? And I know you're big on esports.
Yeah, well, like if you look at the score and you look at the activity in the score, first of all, like just an amazing engaged universe. And this time of year, when you would typically have football and basketball, and just like the end of baseball, their numbers, their daily actives would have been unbelievable.
Yeah.
Now their weekly actives are unbelievable, probably more unbelievable than they otherwise would have been, because we have gambling embedded in some states, but B, because people are not in the arenas. On top of that, you talk about e-games and esports, I should say. That's another core focus for them. And so the engagement on esports is extremely high. You look at like what's happening with Twitch and how Amazon's trying to leverage Twitch as more of a broadcasting platform with the ability to advertise and embed purchasing and things of that nature into the whole realm of esports. Massive things are happening there. But obviously, stadium play for esports has taken a backseat.
Another area which has seen significant shift is edtech, right? We have seen huge shifts happening in edtech. Do you invest in edtech? Do you have views about it? What do you?
So we have we have a couple, 3 or 4 active ed tech portfolio companies. So yes, it was a big area for us about 5 years ago. The truth of the matter is that from a paying perspective, that category, now it's picked up because of the digital tools, but for a long time it was like, you'd grow and then sort of flatten out a little bit. And we've got a few very, very good stories in the ed tech space, interesting ones. And I'll tell you a couple of stories. One is local. It's in Toronto. It's called Kira Talent, and it's a remote interviewing platform for colleges and universities in order to, assess their potential candidates. And they've essentially replaced a telephone interview and a written interview with asynchronous questions that can then be distributed to a bunch of evaluators who can score the same person multiple times. So that company has added functionality. If you think about this in a post-COVID world where people don't really want to get on Zoom, but they more or less want to be able to hear and see the person, and they can chop up the interview questions and watch them whenever they want. So we've seen some, and that they've got probably close to, I'd say, 200 schools on that platform. Emily's just done a fantastic job there. But the other company that I'll mention is a company based, and by the way, we have also like kids-focused online learning tools. Tinker is the company. Company has always done well on a paid basis, and that's so that you can provide a platform for your kids to like learn Scratch in a very methodical manner. Great company based in California, really wicked entrepreneur. I mean, obviously all our entrepreneurs are wicked. He's great. And I mentioned Emily's doing some amazing things. And then there's a company in Boston called AdmitHub that is that's a true platform that universities and colleges send out to applicants and also to their entire base of students to be able to communicate with them. And they do it in such a way that they have implemented natural language processing. They pull in a lot of the content from websites. So you can ask questions that you otherwise would have had difficulty finding the answers to. Could be anything related to admissions, to things that are happening on campus. And because of the remote nature of most students right now, they've just seen an incredible uptake. That's one of those companies that I'm talking about that's really had, you could call it counter-cyclical.
Awesome. We have a few more questions coming in. If you can take these as well.
Let's just see here. Go back here. If we are pre-revenue right now, what do you recommend for development funding? It's a Sebastian, it's a good question. I don't have a great answer for you, unfortunately. The easiest answer would be to just, go do what I don't know what's going on at Mars right now. I haven't, I used to be on the investment accelerator board there. I don't know where things stand there. I don't know if, like a lot of the small, funding sources, I don't know that they put the brakes on, but the accelerators in Toronto, I know are still active. Like I know Techstars is still doing an intake, but I don't have much more beyond that.
Sebastian, we'll at TIE Toronto, we should be able to help you make some of these connects. I would think that angel investment is a good idea at this point in time to do, even though angel activity has gone down, but there are still several angels who are putting in money. There are Techstar very certainly. I think they're just taking around closing a batch right now. There are a bunch of other accelerators that you should possibly take a look at that. I will be happy to help with that.
Okay, Jackie, since more activities go online during pandemic, we see quite some Canadian early stage pre-seed or seed companies trying hard to reach far to the US investors for fundraising. Do you think that's a good idea? What's your advice for these early startups regarding fundraising? Look, it's never a bad idea to reach out and try to connect. I have noticed for us that the number of inbounds that we've received has gone up. I'm going to say 3, and I'm not exaggerating, 3 or 4x from US based companies that are just finding lists and pushing their messaging out. I think, Jackie, to be honest with you, I think it's kind of hard to do outbound. And Kanchan, you'd be a much better person to answer this question. But doing outbound and having somebody actually get interested and end up funding your business is not easy. And the best thing to do is to try to associate yourself with someone who can make introductions for you, whether it's another founder, which is usually a great way to get in, or whether it's an investor that that might be at a later stage but knows earlier stage investors. But I would say just doing outbound like that into the US, those guys have a ton of deals that they're looking at, and you need a good way in, and you likely a connection and or a warm introduction. You will see a much better response rate.
Yeah, I completely agree. It is always a good idea to go through a warm introduction. Usually a portfolio company founder is a great idea. Angel investor, if you have one, they are certainly a great idea. And like Alex said, that if you know a late stage investor and you're too early for them, they make some really good introductions as well, because their words count. Also, where in US really go is important. Being here in Toronto, New York, Chicago, that's a much better place to tap investors. They are a lot more open to investing in Toronto than Bay Area investors. Bay Area investors are, well, they've started looking outside Bay Area sometime back, but there's still very few Bay Area investors who invest in Toronto-based companies.
And Costas, you've got a question about health tech being outside of our funds area of focus. Speaking broadly of the interest from an investment perspective, it is. We've done a few health tech deals. I sit on the board of a company in Toronto called Swift Medical. It's really about home health and wound care management, and providing tools to nurses and skilled nursing facilities, but also to the nurses who will come to the house. Look, this is an extraordinarily hot space right now, actually. Home health, there's a ton of investment being targeted at home health. I would say there is a ton of investment in Toronto itself being targeted at home health. You've got the guys at TELUS Ventures, Lumira, you have Maple, which just took in a ton of money from shoppers. I would say that it is, depending on the deal, health tech there's a massive amount of money going into that category right now. We are pursuing an AI-powered skill-based recruitment platform. We have a proof of concept, and prior to lockdown, we were onboarding early adopters. As corporates being bootstrapped till now, things are in disarray. Oh, how likely can we get some funding to extend runway, and should wait till when to see favorable wins? Okay, Somnath, disarray is not a word that we should be ever seeing in the venture community. Okay, people in venture only talk positively. But I would say at the same token, you are probably not the only company that is, quote, in disarray and having difficulties. And more importantly, that proof of concepts, we are seeing this, that proof of concepts and getting budget to convert them is taking is a lot more difficult, and getting postponed a lot more than it has in the past. And obviously, the reason for that is that if you were in a process where you were in a proof of concept in March, April, and May, in all likelihood, the budget for that got cut inside of a large corporation. Either their budget got cut in half or got taken away completely and has not been given back to them yet. And so I would say you're probably looking into next year before you see some real activity. But I will say that we are seeing corporates who have committed to technical transformation continue to invest in new products. A good example for that would be Blue Jay Legal, which is another board that I sit on. And they sell into law firms, they sell into accounting firms, and they have been able to not only sell proof of concepts during this time, but also convert them. I think that the scope of the projects that they converted into could have been way larger in pre-COVID times. But also what's helped them, I think also is people being distributed. I would say most investors though, Somnath, will look at this and say, you're bootstrapped. Things are not as mechanical as they should be. In other words, you put $1 in, you don't know how much is going to come out. You're probably going to have to, you may have a tough time getting favorable terms on funding. And in fact, if you could do a couple of more paid proofs of concept to get you through to something a little bit more stable, and be ruthless and not take any work on for free, it might be your best bet.
Also, Alex, I was thinking that maybe it's also an opportunity to relook at how the recruitment is changing in post-COVID world, particularly with a lot of hiring going remote. And what are things where there's an opportunity to create a newer product to tap those opportunities?
We're seeing interesting things with 7 Shifts, which is a labor management platform for restaurants, based in Saskatoon, office in Toronto. Majority of the restaurants on the platform are in the US. And I would say the one thing that we're seeing is interesting was you just as adaptability, as an example. What we first found was that companies needed a break. They needed to make sure that they would have the revenue just to sustain their rent. We gave a bunch of restaurants a few months on waiving their fees. But what we did in that time period as well was we added different profiles to help restaurants accommodate or change the way they're delivering and making food. And so in some cases, restaurants are now making their employees delivery people versus before, which is when they were going to a third-party service and initially paying Uber and Uber Eats and et cetera, 30% for every dollar that was coming in. So there have been transitions in that model, and you might be able to find a different market to address with your existing platform that makes more sense for the way the market has changed. Anuj, do you feel momentum in new remote productivity tech may continue beyond 12 to 24? Is the VC community looking at these kind of tech opportunities and solutions more favorably than others? I think that what we're seeing now. Okay, so first of all, I'll bet that everybody who is remote is experiencing the same thing that we are experiencing as a firm, that your companies are experiencing. Kanchan and Nuj, I'm sure you're experiencing the same thing, which is like you're engaged with your employees, but there's still a level of disengagement between everybody. And so if there's a great technology that's going to come and try to solve this disengagement problem, or the re-engagement problem, or the energy problem, then I think that there's those companies will get funded. But I think also, like, you look at companies like Slack, look at companies like Zoom. Those to me are indicators. Zoom's a real tough one. One week it could be up 40%, and then the next week it could be down 20. And I've rode that roller coaster from the beginning because I loved the way that company was managed. And I knew a couple guys that were investors in it, and both of them said to me, like, Eric is one of the best operators they've ever met in their life. I bought the stock. I told my brother to buy the stock. I rode the stock up to triple. I sold a third of and it just keeps going and going and going and going and going. But I think that these wild swings that you're seeing in Zoom, I think that and again, I like, if you look at Zoom and you look at Slack, you can't compare them to Microsoft because they're not multi-dimensional companies, right? They basically have a single SKU. Both of them basically have a single SKU. And so if you look at both of those companies, you say to yourself, Dropbox, I don't know what it's trading at today. But my point is I'm not sure that as a basket of goods, retail investors are investing in that hype anymore. But I still think that there is some market to be found in new and emerging ways to do remote work. I didn't give you a direct answer, but I think you sort of get an idea of the mindset. And of course, anything that the VC community invests in, we've got a view that it's not just going to be a 12 or 24 month ramp. It's going to be a 10 to 12 year ramp.
Awesome. I think that was great. One last question before we end the session. What do you think, is there any one particular thing which really surprised you during COVID? Any particular technology, any particular business which you didn't think had a chance, but they suddenly dropped their head up and started growing?
Honestly, it's not that. That hasn't surprised me at all. What surprised me is the fortitude of the financial markets has surprised me. Like, it shocked me, and I shouldn't really say that because I should be as optimistic as I told you guys you should be, and as I said to Somnath, you should be. Like, I need to be, I should be sitting here very optimistic, and I am, because the markets sustain themselves through the worst part of this. And if you look at the numbers and you look at the way investment dollars flowed, and while it was still to B, C, D, and later deals, the market lost a lot of traction and a lot of interest and a lot of momentum with SoftBank really screwing things up. But truthfully, the markets in general sustain themselves. You cannot compare this period to any other period in venture. I thought this was I was hoping it was going to look more like the rebound after 2000 versus, which took some time, but it actually came back real strong. And then I was really hoping that this was going to be more like, after 2009, boom, things just took off, at an 11, 12% compounded annual growth rate. Markets were unbelievable. Boom. It rebounded. It never even declined that much. Okay, the private markets never took a dip like the public markets did. And they never, like, you'll see, if you look by the end of the year, my prediction is going to be we're 90% capital, the same amount of capital, 90% of last year's, we will deploy 90% of last year's capital into venture this year, into IT, but it'll probably be into 65% of the companies.
Great. There's just one last question. You want to take that before we close? We know we are running out of time.
Most early stage VCs are suggesting revenue positive as being a requirement. Yours is $100K a month. which used to be more Series A. Are you able to give us a sense of what this range is for others? So ours is, I would say, ours is like approaching 100 a month, which means that, I look at this and say, if you're at 60 a month, but you're putting 10K on, it's a perfect time to talk to us. Or you're 60 a month, you're putting 8K on, it's a perfect time to talk to us. $1 million annualized is really kind of 80K a month, just to be clear. 100 is just an easier number to describe to people. I would say that I think Series A's were more like 2 million, 2.5 million in the last 3 years. And that B's were kind of more like 6 to 8 million of ARR, which has really been more my experience lately. And that you're getting from kind of an angel / pre-seed round to a seed round. So everything's kind of stepped its way up. And I also don't think that that series names mean anything anymore. That's the other thing. You could have we just did a $250 million Series C in Greenlight. Like, that's not a traditional Series C, and the company doesn't have traditional Series C benchmarks. It just happens to be the fourth round of financing. In California, you got an angel round, pre-seed series, pre-seed bridge, pre-seed series bridge, pre-seed series bridge, series A. And then all of a sudden, like, the company finally has raised $5 or $7 million in that amount of time in those various rounds. It needs to convert, or even more. And you're talking about a seed round that's going to be the 5 million converted plus another 5 million in at a pre of 20. Like, that's why those things, I think, are out of whack. So I would say, I don't know if that gives you a good sense, Sumathi, of what the of what the range is for others. But I actually think that you got to look at the size of the fund and how much capital they generally deploy, and figure out if that's what the match is for your deal. It's an easier way to go about it than it is to call it a Series A. And then the last thing that I'll say, that really the transition that's happened sort of since AngelList launched, and you get these super clusters of accredited investors and putting money in. The major trend that in my mind that's happened is just availability of non-traditional sources of capital has forced a model change for many VCs. And so, from my perspective, I would have told you 10 years ago, we would have said we take board seats, we aim for 20% ownership, and we follow on up to $15 million. Well, I could tell you today, we observe in some cases and don't take board seats. We feel like getting 20% ownership is very difficult, writing kind of a $2 to $3 million check now at the A, let's say. And the last thing is maximum of $15 million. I don't think is a case for us anymore either. We can do an SPV and have done SPV investing out of through our LP base. So I think the game has changed completely, and that all had to do with the way it started to change through AngelList.
Awesome. Thank you so much, Alex, for your time. Very helpful answers. Thank you for being very forthright about most of the answers.
Oh, my pleasure. I see, just Sumathi, I have a follow-up point here. Listen, this is very possible that someone raised $3 million on a 100K ARR deal. You cannot judge. It is beyond me. We have a deal that we're insiders on that has almost no revenue, that received a term sheet for a $28 million pre. So you go judge whether or not that's market term.
Yeah, in fact, Sumathi, Alex had explained earlier, a lot of it is got to do with what stage the fund is and how much money they have raised, all of that. And of course, how hot the deal is. FOMO still works.
Yeah, I mean, this is like, look, the markets are unpredictable, and and nomenclature means nothing, but the important thing is to just be comfortable with the amount of money that you're raising and being able to use that money to achieve the goals to get you to the next round.
Great. Thank you so much. We'll close this.
Anytime. Anytime.
Awesome.
All right. Take care.
Have a great evening.
You too, guys.
Bye, everyone. Thank you for your time. Thank you for the questions.
Thanks, everybody.